Hi everyone, welcome to Fundamental Finance, a podcast where we talk about financial literacy. Today, joining us, we have Saketh, Karan, Atul, Basil, and myself, Bach. As a disclaimer, this isn't a show to tell you how to manage your money, but a show to teach you how about important financial concepts to improve your financial literacy.
Over the years, Americans haven't been properly saving their income. 20% save only 5% or less of what they make, or 20% save 6 to 10%. Just 16% are saving more than 15% of their income. Reports show that most Americans don't have even $1,000 to cover for emergencies. The fact is that without the proper foundations of saving and spending, income for rent, debt, and more, many Americans will continue to fall down this black hole of personal financial struggle.
So I think the issue here is these financial struggles start with budgeting. So what do you guys think are good tips or strategies to follow budgeting? What's a good budget rule?
So most people or a lot of personal financial advisors recommend a rule that's called the 50-20-30 rule. Essentially, you're going to go ahead and spend 50% of your income on obligatory expenses. So this includes rent, this includes mortgage payments, whatnot. These are things you just have to pay, like groceries, gasoline, whatnot. You should spend 50% of your income on these obligatory expenses. 20% should go to savings and investments, and then 30% should go on other wants or needs. So if you want a new phone or you want to pay for your Netflix subscription, that's what that 30% would be used for.
Yeah, so other than saving, your other option would be investing, right? So Atul or Bach, if you guys want to explain something about investing for this audience, that would be really good.
So I think one point of investing is that it's better than holding all your money in a traditional bank account. And I think, especially in this day and age, it's a lot easier to get started with investing because there's many apps such as Robinhood and other commission-free trading apps on the rise that you can use to get started.
I totally agree. Like this is like a Robin Hood era. Like if you go on TikTok or something, there's so many financial people who claim to be at least financial advisors using Robinhood as a basis of getting into stocks. But although that's a very accessible stock option, it's not definitely the best. So you should go check out your options. There are many online brokers like Fidelity and whatnot, and those might also be a better option for you rather than Robinhood, where the risks are high. The money could go up and down. So there's a little bit of research that has to be done there, but Robinhood is a prime example of it. And I think the question is, many of the audience members will be wondering is, what are these stocks or funds that we should be investing in, right? There's a lot of research that goes behind it, but what's a good way to start and play it safe?
So I think a lot of people might agree that when you're a beginner, it's a bit overwhelming to do which stock you want to buy, which stock you want to sell. So what a lot of beginners are recommended is that they should go ahead and buy ETFs. ETFs are typically the safest option. And what an ETF is, it's essentially a collection of stocks of a certain industry. For example, SPY, it's an ETF comprised of stocks from the S&P 500, from the top companies in the S&P 500. It's essentially a portfolio that you're buying into. And what it means essentially is that you, a person who just opened their first Robinhood account, can go ahead and buy SPY, can go ahead and buy whatever ETF they want, a portfolio of stocks of a certain industry that have been selected, and you will receive the benefits or losses based on how that portfolio as a whole operates or its result of. So let's just say this portfolio does really good, or all the companies inside that ETF do really well in a certain quarter. Because theoretically you own this ETF, that means you own a portion of all these stocks, which means that you're going to see your own portfolio and your own returns skyrocket. And the best thing about an ETF is first off, it's hassle free. You can just go ahead and plug in your money and just let it grow. And B, it also mitigates a lot of risk compared to stocks such as Apple or Tesla, where the beta is high, where it's a lot of volatility. ETFs end up mitigating that risk because of the fact there's other stocks in that portfolio to combat it. So yeah,
I definitely, the thing is, I think from on the basis of stocks, many people see the hype of like, these one name brands just like spiking up in value, right? But the thing with ETFs is those one name brands could also fall really bad, and like it could ruin your portfolio, right? And the thing is, ETFs have such a mixture of stocks that if there are any losses, it typically gets canceled out by the stocks that end up doing good. And I think typically with the ETF, on good terms, you could see a return of like 8 to 10%. And I mean, if you don't want to take those risks, an ETF is a really good option. And having a diverse portfolio within the ETF really helps, as Karan mentioned.
Yeah.
So yeah, I think here we talked about investing in terms of the market, but also where you just keep your money in the terms of accounts, or even how you pull your money from your stock successes or gains, and where you put it also matters. So these would be in terms of custodial account, right? And we've heard of a Roth IRA and a traditional IRA. And I don't know, I think if you guys break down the Roth and a traditional IRA, it would really help.
I think before we get to that, with all this talk about, stocks and whatnot, of course, there's some people that, want to get into it, but maybe they're not 18. So like me, for example, right? My dad and I were somewhat interested in the stocks, especially after what happened with GameStop. And so I was wondering if anybody knows like sort of any like the benefits of like, a custodial account as they call it for.
Yeah, so that's actually a perfect topic. So a custodial account is basically an account that you could use to manage stocks, but it would be under your parents' name, right? So you could ask your mom or dad to open a custodial account for you under their name, and the money can be cashed out like a typical brokerage would allow you to. However, these would go into I believe Roth IRAs or traditional IRAs, right? So your contributions go into those accounts, and then you can pull it later. And depending on the circumstances, they might be taxed initially, or they might not. Some money to a certain limit will be tax free, and if you leave that money in there till your retirement age, it'll just compound interest and really pay out pretty high. So I think I believe if you're under 19, the first like $1,000 and $1,050 is tax free, and then the next 1050 is taxed at 10%, and then the tax increases from up there. So depending on the account you leave it in, it could reduce your taxation.
And I
So
heard you mention something about, Roth IRA. So I was wondering if you could also like, expand on that, or someone can segue out from that and expand on that.
yeah, Bach or Matthew, I think if you guys could break it down for us.
With a Roth IRA, after about 5 years, you can withdraw your contributions at any time. So it's free from both regular income tax and the 10% early withdrawal penalty. It's because you already paid for a fee for them.
Okay. And I believe after you've withdrawn like the whole contribution, and you begin like withdrawing the investment or the compounded interest from that, then you start facing income tax and then penalties. But then it's like there's a like Roth IRA ordering rules or something like that, and the Roth IRA lets you get benefits of the tax deferred investment income and building a retirement plan, but the funds can be withdrawn early, although it's not really recommended. And those differences might make it really important to choose a Roth IRA over the traditional IRA. And I guess to give you guys the traditional IRA, it's a retirement investing account, which uses compounding interest. But the only requirement is you need to earn income in order to contribute to the account. And you can give up to $5,500 per year of your earnings to that traditional IRA. And the investment earnings will accumulate on a tax deferred basis. But if you withdraw it before your retirement age of typically 65, you're gonna get some benefits, and you can make like penalty free withdrawals to buy your first home, and there's some certain statutes that let you get stuff out tax free. So yeah, I think that was a good basic breakdown of the various accounts that we can pull money from through stocks, and it's a good basis on investing, right? So for us, it's very easy to buy penny stocks or stock shares given the current apps and systems that we have online. And I think this is a good basis of the various savings accounts accessible to us, although this is not all of them. These are the most common and popular ones, at least when contributing money that you gain from your ETFs or funds or whatnot. And again, stocks are not the only option. You have option. There's also something called options, which is kind of like a spin-off on stocks. These are they also ride the wave of these companies' successes, and we'll get to that in a further podcast. And there's also an option called low-cost mutual funds. But if you don't want to take the risk with any of these situations that we gave to you, you could also choose a high yield savings account. So this is your typical bank account, but it gives you back a high rate of interest. Those are hard to find, and they also have these subjective, or I guess constraints with each of them. So you have to see what best works for your situation. Yeah. So Karan, Bob, Atul, Matthew, anything to add, or do you think anything? We
Yeah,
want
I
to
mean,
give the readers anything else?
yeah, I mean, like, I think it's important to note that similar to what Saketh was saying, that these concepts that we're explaining right now aren't like the most advanced ones. These are really for beginners, for those really trying to enter the investing market or entering planning for your retirement. For example, for ETFs, right? These are the safest options for stocks. Sure, you can go in and put all your money into, I don't know, Tesla or Apple or Amazon, but for beginners, typically an ETF is the safest option. And then for retirement plans, it's probably more advised to go Roth IRA and just go ahead and put a portion of your income into the actual portfolio and just let it generate its own. Because at the end of 65, you can receive a lot of money just through compound interest alone. And it's better than other options out there because it's simpler and it's easier for you, the person.
I think something we also need to highlight is, although stocks seem really popular online and stuff, you want to put the money that you're okay losing into stocks. You don't want to put like your savings, right? That's the thing. So let's say you want to start with $200. You should be ready to lose those $200 if you're putting it into the market, because it's volatile. It could change any moment, right? So that's something you need to pay attention to. And all these options we've given you, right, the audience, think about your situation. Do you have an income? Are you making enough money? Are you living paycheck to paycheck? Or do you have your parents or someone else giving you money, right? So all of these options depend on your own financial situation. And although these are the most popular, these are just very traditional, basic routes, and you don't have to follow them yourself. So check out the topics. I mean, check out the options we've given you, and you got to see what works best for your situation.
And then do more research also after the podcast.
Yeah.
To like better understand yourself with more of these concepts.
So I think today we went over a very rudimentary basis of savings and investments. And I think we are good for today. So thank you for listening. Make sure to share it with your friends if you believe it helped you. And drop something in the comments if you have any advice, tips, or just want to give us feedback. Thank you.